All right, we're back. This is this week's market call for the week ending January 30th, 2026. I am your host, Dan Bustamante. I'm the founder of the research report, LongVol Report. You can head over to LongVol Report. We publish that report each and every Sunday. My analyst and intern put that out for all of you. We cover equity research there for you. Some of you are subscribers that tune into the market call. Then also some of you are clients that we manage assets for as well. For those of you guys that are new here, I do run an investment firm called Bustamante Capital Management, also known as Bustamante & Co. We manage a value/event-driven strategy through a separately managed account structure for high net worth individuals, accredited investors, and pooled investment funds. There's information at Bustamante & Co. as well for all of you to follow on what we do and information on the firm there. Okay, before we get into this week's show, quick disclaimer, this is not financial advice. I'm not your financial advisor. You want to consult your advisor, your guru, your tarot card reader, whoever it is, for investment advice. This show is purely intended for educational purposes only. These are my opinions about the markets. We do cover some positions, not all, for privacy reasons, that we do manage in portfolios for clients. And in this week's show, I'm going to give you guys some updates on some key earnings names that we've held in portfolios for the past year or so, some just recently as well. One of those names is on your screen. If you're watching, if you're listening, not a big deal. And by the way, if you guys are listening to this show, it works. You get more benefit if you watch here on Spotify. You can actually just blow it up and watch it as well. And this week, we're going to go through a lot of charts and some data from earnings. But we are going to talk about Boeing. They had earnings this week, reported just as expected. The stock sold off. Look, we wanted to see it sell off selfishly. I'm going to talk about it here in the show this week. Give you guys a quick update there on that, on positions, what we plan to do. Then I want to go through VF Corporation. This has been a company we've been investing into and out of for the past 2 years. This is a pretty big turnaround situation, and it is taking a lot of time. They had earnings this week. I'm not going to sit here and say they were extraordinary earnings. They weren't bad earnings either. I would say more middle of the road. But there's some updates there worth looking into. We'll talk about it quickly and give you guys some insights. Then we're going to move over to Charles Schwab. They had earnings this week as well. This isn't a big position for us. I do just want to cover briefly some key numbers from earnings on the company and talk about it there with you all. And then we'll move over to Deckers. They had earnings this week as well. This is a company I talked about for those of you that we manage assets for last fall. I gave you guys a letter and I gave you guys an update. I basically said, look, there was something on the last earnings call they said about their margins and the tariff situation that caught my attention. I wasn't necessarily super convinced at the time to make it a big portfolio position, but I was convinced enough to put leap options in the portfolios, which we did. They were up 50% or something like that this week. And you guys have seen it if you looked at your portfolios. But they had an earnings call this week as well. They said exactly what I was looking for them to say, and I want to get into details on that this week as well. Okay. Finally, I'm going to give you guys a quick update. This was a new portfolio position for us. Again, this is opinion, not advice. We sold out of this position. We took a position in Camping World in the month of January. It was up like 30% in like 3 weeks. All right. So I do want to go through this quickly. We may or may not take another position in this. However, what I want to do on the market call this week is give you guys a quick 101 of why the rally and what we're looking for going forward. Okay. So that's what we're going to do in the market call this week. And then finally, we'll go through the Global Fund Manager survey. We'll go through this quickly. I don't look at a lot of research outside of earnings reports, earnings calls, and understanding companies that we invest into. So I'm not out there reading Barron's too much, except again for, some things I'm looking for opinion. I'm not looking at CNBC. We're not looking at Reuters. I'm not taking the opinions of others. When we invest into companies, we're going to the source data. However, the BofA Global Fund Manager survey is something I look forward to every single time it's put out. I read through this thing meticulously. In fact, I recorded the show earlier, and as I was going through this, I was sitting there, and I was again in the back half of the show, and I'm reading it, and I go, you know what? I'm reading November's survey, okay? And by the time I got through it, I realized it. I had recorded too much, and I had to record the show. Not a big deal, but we're going to go through the BofA Fund Manager survey this week. For those of you guys who've never seen this, I'll explain to you what it means, why it's important to me, and I want to go through some key charts, because a lot of the charts they go through here help me as an investor to understand potentially where money flows are going to go. In addition to that, they also help me to understand where there might be risk on the horizon. And I do think right now, I've talked about it with a lot of you, if you got our 2026 outlook or you watched our 2026 outlook, I do think there's going to be risk in the markets in 2026. It is a midterm election year. You've got geopolitical risk with Iran, some other stuff there as well. It's again, there's a lot of unknowns in the market. And this isn't to say that every investing year there's not unknowns. There are, obviously. But again, I'm definitely concerned for the broad market. I'm not concerned for our portfolios, which we'll talk about as we get through the show this week. All right. So that's what we're going to get through. That's the introduction to the show this week. For those of you that are returning, again, a little bit different format this week. For those of you guys new here, again, if you're new, watch them. You'll be able to learn as you go through this. We put these out 2 times a month. If you have questions, you can send in questions. I answer those questions at the end of the show every single week. All right, so let's get into it. Let's start with Boeing and kick that off. All right, so let's kick this off in Boeing. For those of you guys that have been around for the past 2 years, we've been talking about this company, and obviously it's been hated. If you look at the story of Boeing, what's been the story? They didn't have a good work culture. The union was having disputes. They didn't have a CEO in place. They finally got a CEO in Kelly Ortberg. He's improved the morale of the business. A lot of things have been improving with him in charge. Obviously, production issues, cash flow issues, pretty much every mess that you can imagine Boeing had for the past 3-4 years. We were talking about this in fall of 2024. We took positions long in this 2 or 3 times in 2025. We took another position recently on this name as well. They had earnings this week where I want to go through those numbers. Before we go through the numbers, let's go look at the price chart and talk about a few things and see where this company has gone and where we think it's going to go in the future. And if you go back and you look at this is legitimately, in fact, let's just pull this up here. This came across my attention in October of 2024. Okay. So back when we're trading at 140s, we took positions in this. We got out of the position. We retook a position last April. We got out of it. We shorted a little bit of it. This was earnings the last fall. The market overreacted like it typically does. We bought positions for all the portfolios. If you guys saw back in November or October, I forgot the exact dates. All of you had positions in the portfolios, a combination of equity and long-term leap options, by the way, which we took the opportunity, if you didn't see, to sell before this recent earnings, which I'll talk about a little bit later. And we bought this move higher, and it's been a good move so far. All right, earnings came out this week. Pretty good earnings. We're going to get through them in a second, but like most things, the market priced it in. And this typically happens in the markets. I talked to some of you. I held a conference in Phoenix. A lot of you came out in November, and we were sitting in that conference room. And one of the things that, for those of you that were there, remember me saying to you, because I think during that conference, if I recall, I think I was literally adding to positions in the portfolio that day. In fact, I think I pulled up one of the portfolios and we went through this. But I told all of you that once we got to this earnings, that every journalist was going to start writing about this, that every investment bank, sell-side analyst do what they always do. What they do on Wall Street, they're always late to the idea flow. And you guys have to understand, I've worked in this business for nearly 2 decades. I've never on the sell side, thankfully, by the way. But there's a conflict of interest, all right? And when these things start to appreciate in value, everybody then wants to talk about it. The way that we invest in markets through a value approach, through an event-driven approach, is trying to identify a situation when nobody wants them. And yeah, there are situations where we buy into positions and we do take heat. Not everything is instantaneous, as much as I try to help that, but we try to buy into situations when nobody wants them. Boeing was a perfect example of this. Now it's pulled back. We think it's going to go lower, but selfishly for us, it'll be an opportunity to re-add to those positions as we get into the heart of the first quarter and the second quarter. Okay, let's talk about some earnings highlights for the business. This stuff matters. Again, we look at information. We're looking at source data. I don't care what the journalists say. I don't care what the analysts say. We do all of our own work. That's the way we prefer to do it, and we've done it for a long time. All right. So they acquired Spirit Aerosystems. I remember this business. It was a company I was looking at years ago. This is a big deal for the firm. But revenue 57% year over year to $23.9 billion. The full year 2025 was $89 billion, up 34%. Commercial airplanes drove a lot of the growth with higher deliveries. Okay, this was a big deal for the business. It was the highest deliveries in commercial since 2018. That's a big deal. Okay, if we go back and we look at the problems this company was facing, it was a lot of the delivery issues. That's pretty much for the most part fixed. And that was a good thing to see as well. Okay, GAAP EPS was 1023. This was a big deal. It was boosted, by the way, by the digital aviation solutions business. They sold that. If you didn't see this, it's obviously here in the third point. They ended up selling this. It did boost it a little bit. There was some concerns with this, by the way, so the stock did sell off a little bit. And some of the general concerns with why the stock sold off were kind of that idea. There's concern there was a one-time gain based on that sale that kind of masked the profitability. Look, I don't think that's that big of a deal. The second thing was, we'll get to a negative. We'll go back to the positives here in a second. Their defense business had a one-time $600 million charge. All right. They make the KC-46 tanker, big defense military plane. There was a one-time loss on that. Not that big of a deal. And I'll explain to you why it's not a big deal here in a second when you see the rest of these numbers. All right. Operating cash flow was $1.3 billion. And the backlog, this is the key here, hit $682 million. All right. What else could you want from a business when you're buying into it? Over 61 commercial planes and a backlog of $682 billion. When you look at buying companies, okay, the reason we're in value is for a lot of reasons, but one of them is this. I don't have to sit there and predict the future of a business. When you look at a growth business, and I'm not saying they don't work, they do obviously, it's hard to predict future revenue and what that business could do. You have 1,000 analysts on Wall Street that are very good at DCF models, Excel, et cetera, to try to predict what that's going to look like. I don't have a crystal ball. It's easier for me to look at situations and understand that this is a legacy business. It's also easy for me to understand that the U.S. government effectively backs Boeing. You've got a duopoly. You have Airbus and you've got Boeing to run the plane situation. Trump is arguably one of Boeing's best salesmen so far doing what he's done. It's hard to see this having a lot of issues, especially with this large of a backlog in the business. And I think a lot of people either overlook this or allow the mainstream headlines from the Reuters, the Bloombergs, the CNBCs, it goes on, to mask the actual issue of the business. This is what I've been talking to about a lot of you for the past year. Ignore the headlines, understand the business, and understand what you own and why you're buying it. This has been a good investment for us. We sold a lot of our position before the earnings report because we did expect a sell-off. Not because of what I said here, by the way, but because of just kind of a technical situation that I was looking at, as well as just for the pure sake, legitimately, of booking gains. Okay, so there is some kind of situation here of a little bit of concern of supply chain issues on the 737 MAX. It's a little bit slower than targeted, despite some of the FAA approvals, but we're not too worried about this. The point in this business right now is they've turned the corner. Kelly Ortberg is doing a good job. The backlog is positive. The free cash flow is positive. Everything is extremely hitting all targets right now. So when we got this pullback, this week, we want to see that. Okay. Our plan, again, this is opinion, not advice. I'm not going to tell you guys for sake of the show, especially those that again, are just watching this. We'd like to see this pull back a little bit more, maybe the low to 200s. And then we'll start to get into a new position on this because we have targets into the end of 2026 that are much higher than this. Okay. That's the update on Boeing. We're happy for the results on this. We're happy for that position. And we're happy we book gains to secure some P&L. I know one thing in investing, when people start to make money or they buy a company, almost seems like it's taboo to actually realize the gains. Okay. I'm in the camp of, if we've got gains and we've hit our targets, let's book them. We can always get back in. Okay. That's number one. Let's get into VF Corporation and talk about this earnings and give you guys a quick update there. All right, so VF Corporation, for those of you guys new to this story, we've talked about this for the past 2 years, literally since, again, 2024. We've owned this 2 or 3 times the past 2 years. This is one of the portfolio positions. It's kind of like, not the black sheep in the portfolio because it has performed, by the way, but it's the position in the portfolio that's just absolutely taking its sweet you-know-what time. And we're okay with that. Look, sometimes when you invest in markets, things take time to come to fruition. Our investment mandate, the way we invest, is anywhere from 3 to 24 months. When we look at taking portfolio positions, we try to hold for 3 to 24 months. We're not looking out for 10 years. I'm not looking out for 20 years. Now, that might change, by the way, if I was a central bank with $50 billion. It might change if I was a mega hedge fund with $5 billion. Maybe that would change our investment approach. But we're not. We run a separately managed account model, which allows us, especially for clients that come in, different parts of the year, to focus on a 3 to 24 month timeline. All right. And that's a big part of our investment research process. When we're looking at businesses to buy into, I don't want to wait 10 years. All right. We're looking for returns in the portfolio at 3 to 24 months, but this one's taking a little bit longer. We're pretty much at this point, pretty darn close to the 24-month timeline. But what we've done differently is traded in the business and out of the business a few times which has been profitable for us. All right, this is the CEO, Bracken Darrell. He's done an incredible job, by the way. I was on the earnings call. This is what he said. In Q3, we delivered growth during our peak holiday quarter and beat revenue and operating income guidance. The North Face and Timberland each grew 8% and 5% on a constant dollar basis, while Vans results were as expected. The Americas region has its strongest performance in over 3 years, while global DTC inflected to growth. We remain on track to deliver our medium-term financial targets and are excited about the future of our business. All right. What does all that mean? We're going to break it down here in a second. Let's talk about some numbers of the business. Revenue was $2.8 billion, up 1% year over year. Not big, by the way, but not bad. Again, just kind of like a middle of the road earnings. Okay. But it's good for us. And they paid down debt, which is a positive, which we'll talk about in a second. They sold off one of their brands. One of their brands in the States is called Dickies. It's more of a construction work brand. They completed this sales here. Big deal for the business. They've divested out of that, which was, we think, was a positive for the business. The North Face was up 8%, and that was a positive. Timberland was up as well. Direct-to-consumer inflected, like we talked about. Operating income expanded. Margins improved slightly, and the company made progress on debt reduction. Okay, this is a big deal in this business. If we go and we look at the debt of the business, I've talked about this before with a lot of you. When we look at buying companies in the value space or turnaround, there is no necessarily number or ratio. There's art ratios, by the way, you can look at to say, look, well, how do you determine this? It's a situation by situation approach. Okay, when we looked at Vans and you look at the situation for the feasibility, of turning this business around, one thing they've done extremely well is getting this debt down. Okay, this is VF Corporation here. They paid down their debt extremely well. And you want to see that, okay? If you're turning around a business or anything in real life, think about a real life business. If you're going to go bankrupt and you can't be solvent, well, you don't give yourself a path to fix the other brands. So in selling down these businesses, it's been a net positive for them. And paying them down is a big feature that I don't think is talked about enough. I think they've done what they needed to do to give themselves room to run with the other brands. And that's a positive for the business, all right? There obviously is some negatives here. I want to talk about the negatives. I don't want to sit there and play one side. Let's talk about the elephant in the room. The elephant in the room is the Vans brand. If you guys don't know, Vans was a big deal in the early 2000s. I was in grade school. Everybody wanted Vans for the skate culture. It was a big deal. In 2020, this may or may not mean anything to a lot of you, but for the Vans Warped Tour, they canceled. The Vans Warped Tour was a very big thing for marketing for this business. They got rid of the Vans Warped Tour. And you should familiarize yourself with how big that was. They've decided to bring that back. That's a big deal for the business. I'm assuming, as well as others, by the way, in the fashion industry, because I've read a lot of these blogs about this, that's going to make a large impact to the Vans sales. In addition to that, they've done a lot of things as far as designs go, new styles of shoes, and there's a big shift going on in that culture I think is worth paying attention to. However, revenue was down 8%. And it was in line with expectations. So they expected it to be down, and they guided extremely, well on that. Okay. There are some other issues as well we want to go through quickly. Global e-commerce returning to growth. This is a big deal for the first time in 4 years. Okay. So the e-commerce business is performing, led by the Americas. Okay. So you're seeing some signs of life there. That's a net positive. Don't let that go slip under the rug unnoticed. Number 2. Positive digital performance again, especially in Americas. I mentioned that. Number 3, momentum in product newness. Obviously, they've made new styles. If you haven't paid attention to this, they're seeing, momentum in the new product and in the new version. All right. Number 4, quick cultural tie-ins. They've had some other things, some collaborations they've done. Those collaborations are working as well for the business. Again, those are some positives. Go to a few negatives here. All right. So some of the challenges they're seeing in the business are regional weakness. There are some declines in certain stores, but again, they're still trying to work on a few things there, et cetera, et cetera. One of the other things on this as well is they were saying on the call is that there's some kind of macro softness on spending in certain sectors in the wholesale and the physical market a little bit, but we're not too concerned about that. But again, they're still trying to get this to single-digit decline, which they've done. And hopefully, as we get into the next earnings report and the one after that, we see some sign of life, okay? So for the most part, as far as this story goes, look, they've done a good job of getting things in line. We want to see Vans inflect. We want to see Vans take off, and that's what we're waiting to see. Okay, the rest of the businesses are fine. We're not too concerned about this. Again, it's a slow mover. My views on this have been pretty simple for a long time. I'll share them with you now on this situation. If you go back and you look at this, We've talked about this since 2024. When they came into this business, they were selling off these assets. You got a kind of one-time, adjustment after selling off assets. So you got this repricing, re-rating on the equity. This was the earnings report coming in weak. This is obviously April tariffs coming in, and this has been since April tariffs on the rebound. Okay, the earnings report wasn't too bad. Pre-market, the algorithms took it higher at 10%, then took it down, obviously. When the earnings call came on, they started talking, we got our rally, etc. All right. Short term, there's always market noise. If you're an investor and you don't understand what you're looking for when you go into earnings calls, some of this stuff will shake people out. We were looking for a lot of what they talked about in the earnings call. Primarily, what I was hoping for was more positive news on Vans. I don't think you got it. It's obvious that's open to debate. But again, regardless of what side you're on the fence you're on that, the stock's holding up well. We do think this is going to start to trend in the right direction. I have my views on this. Again, this is my opinion, not advice. I do think when the Vans line comes to life, this will be up 15 to 20%, either on earnings or 2 or 3 days after. Okay. For those of you that we manage assets for, I gave you guys our letter in December. I'm not going to talk about our valuation targets publicly, but you guys should go back and look at that. Okay. So that's an update on Vans. Let's move on to the next one. We'll actually just switch over to Deckers because this is pretty similar to the business. Let's talk about Deckers next. Okay, so let's get into Deckers quickly. Deckers brands, if you guys don't know this business, we'll get into it quickly. We did not have a big position in this. In fact, last summer, I thought this was a short, and we were shorting this, not in all portfolios because some of you in the IRAs, there's no shorting allowed, but in some of the other stuff, we were shorting a little bit of this brand into 85. We bought it in 85s, but there are some things in the call that caught my attention. This is the brands they have. If you haven't seen this, they have UGG boots. This is a big deal. Hoka's, by the way, I own these 3 pairs of these shoes, by the way. I love these shoes. They're legitimately the best running shoes I've ever had. They're expensive, but I'll explain to you why that matters in a second, because on the last earnings call last fall, they mentioned something here about pulling a lever on increasing prices on this stuff, and they did that, and I want to talk about it. All right, so this is a brand that we like. We are likely going to be taking a position relatively soon. I'm not sure when. We'll go to the chart and talk about it, but you guys should expect to see this probably in no later than Q2 in portfolios. We had a lot of you in leap options on this, by the way, which were up. We exercised some of those this week, and we'll talk about the earnings here quickly. Okay, Deckers was a phenomenal earnings report. The full year 2026 results that they went through here, we'll get through quickly, were net sales up 1% year over year to a record $1.96 billion. Diluted EPS was 11% to a record 3.33. Hoka was the standout, up 18% or $629 million. Okay, this was a big deal in Hoka. They absolutely crushed it. UGG was no slug either. They were up 4.9% as well. Okay, their other brand net sales were down 55%. Look, I'm not too concerned about this. Obviously, we don't want this trend to continue. We want to see this kind of reverse on that trend. But these two things here are a net positive for the business. But also, there was something we're going to talk about in a second on their tariff exposure that these guys did an incredible job on, by the way. Okay, last earnings call, when I was sitting on the call, there's a question that came up. They go, look, obviously you guys are affected by tariffs. If you guys go back and you look, VF Corporation, Restoration Hardware, a lot of companies have been affected by tariffs. A lot of you saw what happened last April. Even in real life business, it's kind of hard to do business when you don't understand what is going to happen or what the goalposts are. And in the last earnings call, they mentioned something about being able to pull the lever of increasing prices on the shoes. And I go, look, that's interesting. He says this. I wonder if they can mitigate tariff costs by doing that. Okay. Obviously, their shoes are not cheap. These shoes are anywhere from 140. They might even be $300. Okay, so people buying these shoes, for those of you guys remember, they're not shopping at Payless. Okay, people are paying up for this stuff. They're expensive. They're probably going to pay a little bit more on this. And initially, on the prior call, they had expected the tariff impact to be about $150 million. Okay, that's a big deal. That's a lot of money wasted. It affects margins, et cetera. And we were curious to see what they were going to do for it. To mitigate this, they did a few things. Number one, they did selective and staggered pricing increases. So around the U.S. market, they used their pricing power They came in, they kind of did some small rollouts, not at one time, and they wanted to see how the consumer would react. They started this in July, and it went through the fall. This was, again, obviously a success because going forward, they talked about in this recent earnings call, they got that cost, which we thought was going to be about 150, down to about $25 million. All right. So they mitigated their tariff costs by selective price increases on the shoes. Okay. Not every brand can do that. That says a lot for a brand where you can go out there and say, look, we've got to increase our costs in some markets to make up for this. And for those of you out there, I'm not going to get into political discussion on the show. Tariffs are a tax, okay? It's what people out there don't want to discuss this. I don't want to have discussions with them, to be clear. But again, they've got to make it up somewhere, and this is where they made it up. And this was a big deal. They talked about it on the call. I don't want that to get swept under the rug. I don't think it did. Again, this is what I wanted to see. I wanted to understand, how are these guys going to get around the tariffs? And they did it. Aside from that, UGG's doing a good job, Hoka doing a good job. This was a big deal as well, okay? The second thing they did is they negotiated cost-sharing agreements with manufacturing partners. A lot of their factories are in Vietnam. Again, there was some negotiation, according to the call I was reading through, to help the tariff burden. That's also helped as well, okay? So those are how they mitigated tariff costs. It's helped them to increase gross margins, to bring up revenues, etc. This was a big deal for the business. That's what we wanted to see. Obviously, the share price reflected it because the stock was up 18% today on earnings. I'm recording this Friday night, and it gapped up, and it doesn't look like it's going to stop. Again, not great for us, but look, there's always going to a pullback, and we'll wait for that, okay? Not to not highlight anything else, I want to go through one final point with this. Their share buybacks have been phenomenal, and we'll go through this quickly. In the prior quarter, they repurchased 3.8 million shares for a total of $348 million for a weighted average of $92, okay? Number one is this. When management and the board buys back shares at opportunistic prices, that's what you want to see. You don't want to see the board at all-time highs saying, hey, look, and Schwab did a little bit of this, to be fair, okay? But we don't want to see them buying back equity at all-time highs. They started to buy back shares, and that was a big deal. They have $1.8 billion left. They expect, this is their words, not mine, share repurchases to exceed $1 billion in 2026, okay? So the earnings on this were phenomenal through Hoka, through UGG, through mitigation on tariffs. They've done what they can do through pricing power. Can they continue it? We're going to see. And the final point I'm going to leave you with is this. Both on VF Corporation and Deckers and some other portfolio positions we own. Let's pull this up here. We may be able to see the tariffs struck down in February, okay? As we got into that decision, I'll give you something that's a little bit nuanced, but this is something I pay attention to. Look, I do this, you guys know, pretty much nonstop. The price action leading into these events, because right now the market expects, full disclosure, that the tariffs are going to get struck down. Okay, this was Deckers, by the way. This was the move that it made. I mean, extraordinary, up 20% today. But as we got into the tariffs decision, I was watching a lot of the price action on a lot of these names, and the market was expecting the tariffs to be basically ruled against. And now we're waiting on to February 20th. If the tariffs are basically ruled against, there will be a short-term tailwind to drive price action higher, not only on VF Corporation, not only on Deckers, but also companies like Restoration Hardware. Some others, we don't get, by the way, we don't own that, to be clear. I'm just giving you an example of companies affected. But you'll get a short-term tailwind from that, okay? And that's something we're looking forward to as well, all right? So that's an update on Deckers. Again, we'll be looking to take a position. Obviously, to be clear with this, we're not going to be buying this up 20%. We're going to wait for this to pull back, you know, whether it's 110s, whether it's 100s, we'll see. And look, I don't have the FOMO gene. So if this goes without us, whatever, we have plenty of ideas. I'm not worried about it, but we are going to wait for a pullback because they always come, and expect us to be into this maybe in 2 weeks, maybe in 2 months, we'll see. But again, this is something that's now on our radar in full view. Okay, that's an update there. Let's move on to Schwab and talk about that quickly, and then we'll get into Camping World, and then we'll go over to the FMS. All right, let's get into Schwab very quickly. This is a small portfolio position. Look, we don't own a big position in this. We owned this last year, And in 2023, during the SVB crisis, by the way, for those of you that weren't here then, I was screaming to all of you to buy this. If you guys don't remember, this thing was down, I think 30 or 40%. We bought this, and I'll tell you a quick story. I was in New York that summer with a good friend of mine, by the way, who's just in town this week. He works at Rabobank. He's the head of macro and cross asset there. I was there for his birthday, and I was sitting at his rooftop at his apartment, and he goes, look, I want you to talk to this analyst. She works at this bank. And because I was pitching Schwab to a lot of people that summer. And he goes, she's a finance or a bank analyst. Talked to her, and she goes, we don't like it, whatever. When I go, look, you're wrong. You guys are always wrong on this stuff. You don't have any money in this. You're just conflicted. I didn't say those, obviously. But she gave me her pitch. She was dead wrong. The stocks at new all-time highs. And here we are today. All right, we took a very small position in this, not because we think this is going to be a 30 or 40% winner. All right, when we put positions in portfolios, we try to look at them at a very minimum. Can we get 30%? If we can get 30%, we'll take a look at it. If I don't see that, we're moving on to the next idea. Typically, when we put portfolio positions in, we're after a double. All right, we don't want anything less. If we're going to put $1 out of risk into the markets, we want rate of return on our capital. As such, I don't think we're going to make a double on Charles Schwab. I think it's probably good, and we've got some of it so far for 20 or 30% based on our entry and some of the option structures we did. Again, a lot of reasons for this are, we'll get into quickly, but I'll give you one of them. The bank business in Schwab prevents this business from trading at the valuation it should. All right. Aside from that, this is a great quality business. And for the record, for those of you who don't know, I started my career there literally at the age of 20, working there 40 hours a week and going to university 16 hours a week. So I know all about the business. I've been there. Literally, my bank account, I still have one of them from age 20 to 20 now. So 20 years I've had a bank account there. A lot of positives, by the way. I'll give you one. For those of you guys that travel, use their bank card. Anywhere you go in the world, they'll rebate you on your ATM fees. This is a big deal for some of you that travel a lot. It's a big deal for me because I can't be bothered to deal with a certain bank and not have to or worry about paying those fees. Okay, let's get into the earnings report. Talk about this quickly. Net income was $2.5 billion. Big deal for the business. Revenue growth was 22% year over year. This is a big deal as well. And asset growth was up 11.9 trillion, up 18%. Trading activity was increased. This isn't a big shock. If you look at trading everywhere, everybody's trading these days. Doesn't make a difference. And it's a net positive and negative, which we'll talk about later on the show. They also hiked their quarterly dividend by 19%. We get a dividend as well. It's better than a stick in the eye. So we'll capture the dividend while we own the equity and try to get our 20-30% out of this, which, again, we're about a quarter of the way there so far on that position. Okay. New assets are growing, direct client relationships are growing, and the buybacks have been big on the business. Now, again, this is not why we bought into this, but it doesn't hurt the business. In 2025, $7.3 billion in buybacks in total, $11.8 billion in buybacks and dividends. Okay. A lot of you also have your accounts at Charles Schwab. This is where we house the separately managed accounts. So if you're a client with us or down the road you become a client, your accounts are at Schwab. All right. We also have accounts at Interactive Brokers. And I'll tell you guys a quick story. I shouldn't say it publicly. I'm going to say it anyway. When you call Charles Schwab and ask him for anything 24/7, it's, I think, the best customer service I've ever experienced, by the way. When you call Interactive Brokers, it's like calling an old school Wall Street desk, a trading desk. Okay. They're almost like, why are you bothering me? I can't be bothered with you. But again, they work, and it is what it is. Okay. So a lot of you have your accounts there. The customer service is great. That's not why we bought this. We bought it because it's a legacy business that keeps performing over and over and over. Okay. The earnings report was strong. The stock reaction was a little weak. I'm not mad at it. But then again, the expectations for this were not that this is going to be, like I said, a company that's going to be up 30 or 40% instantly. That's not our expectation. Okay. We ended up putting a position out in November on this. We're pushing higher, slower, but steady, and we like that, okay? Ultimately, which we're going to get to here in a second, it is a midterm election year. We expect a lot of volatility in the markets. Again, we want to position into certain sectors, into certain names on purpose, okay? So this is going to get us where we need to go as far as rate of return goes, and we have a little bit of capital allocated to that for all of you, and we'll update you as we go forward, all right? That is Charles Schwab. Let's move on to the final idea and talk about this quickly and get into Camping World. All right, let's get into this quickly. Camping World, for those of you who do not know this business, this is right up our alley in terms of investing in value and looking at things nobody is paying attention to. let's talk about this business. Camping World, for those of you that are unfamiliar, is owned by the entrepreneur Marcus Lemonis. He was I guess a big deal if you guys are in business and you know who the guy is. Pretty famous in the business world. He owns Camping World. For those of you not familiar with this business, Camping World literally sells what it's talking about. Campers, RV parts, maintenance, used RVs, you name it, they've got it. This is it here. Obviously, it's a big deal, especially in the United States. This is where they're located, and it's also a small cap business, okay? Aside from this business being on the lows, being on the outs, one thing that I talked about with a lot of you going into 2026 was the idea that we wanted to, if we could, own small cap businesses in the portfolio, okay? If we were looking at ideas, if we could help it, we'd like to own those ideas with some exposure in small and mid caps, primarily because of the cycle that we're in with interest rates. And obviously in a cycle that has interest rates being cut, et cetera, again, we have another discussion in a week or so with the new Fed chair. You would expect companies like this, not only because of their size, but also their client base, because they finance a lot of this stuff, by the way, to start to inflect, okay? This is 2020. If you go back and you look and see what happened to the business, what was happening in 2020, a lot of checks went out to the general public. PPE loans, etc. A lot of fraud, by the way. The checks that went out from the Biden administration, all right? And sales went through the roof, the stock went through the roof, and obviously it's lagged. We're looking for a lot of this stuff to start to reaccelerate free cash flow and margins, et cetera, pending, obviously, what ends up happening with tax returns this year, potential tariff rebate checks, if they get them. Again, it's on the fence. We're going to start to see some type of inflection in the business, okay? We ended up buying these shares probably about the first or second week of January. It really moved a lot quicker than we thought it was going to, literally up like 30% in a matter of 2 weeks. Our initial target was about $16 to $18 a share. Look, we had to book gains on this. We're going to get an opportunity to rebuy back into this, okay? Why is the stock moving? Why did that move kind of happen off of those lows so quickly, okay? There's a lot of different reasons for this. I think the first reason we want to talk about quickly on this was they came out and they signed an agreement with Costco, okay? For those of you that didn't see this, this is their old earnings report, by the way. There's some positives in there as well. But they came out and partnered with Costco, which was a big deal for this business. Okay, so going forward with this Costco partnership, they expect sales to increase given obviously the network of Costco and the lead generation, et cetera, et cetera. And by the way, Costco was also selling gold bars and silver bars. You can't make it up. And I just saw something on Twitter the other day that they're now selling Rolexes too. Okay, so there's nothing that Costco won't sell. It's good for us. So we're going to continue to track this. All right, we got our 25 or whatever percent it was, plus some of the options out of it. We're going to watch this going into the next earnings report. All right, we're not in this right now. I'm not saying we're going to get into this. I'm just giving you guys a heads up so you can familiarize yourself with the business. But there are some other things I'll get into if we take a position again on this going into the rest of the year. But so far, this has made it onto my radar. We positioned it. We made some money, and we'll continue to watch it. Okay. That's an update there on Camping World. That's it for portfolio updates. Let's go to the next part of the call. We'll quickly go through the Global Fund Manager survey, and I have 2 questions to go through on the show this week, and we'll have you out of here in about we're at 40 minutes now. Call it next 10 or 15 minutes. Okay, let's get into the Fund Manager survey. All right, so this is the Global Fund Manager survey called Greenland. This is appropriately titled, given where the markets are now, given cash balances, etc. This is a great title, so shout out to Bank of America for this. For those of you unfamiliar with this, what is the BofA FMS? The BofA FMS surveys 227 panelists with $646 billion of assets that participate in this massive survey through different questions. And there's questions and 112 participants, 280 billion responded to the regional FMS questions, okay? So there's 2 different panelists for this. They question these money managers on different topics. They pull them. They comes out with the charts and the data. A lot of people read this. This is one of the things I read religiously, like I said, all of the time when it comes out, okay? This particular fund manager survey that came out, the bottom line was this. It's the most bullish since July 2021. Global growth expectations surge. Cash levels at new record low. Again, this is probably not a good thing, by the way. When cash levels get to lows, you should expect contrarian views on this. And I'll talk about that as we go through this, okay? Bull and bear indicator at hyper bull 9.4 says increased risk and hedges and safe havens. Again, what happens every single time when things get too optimistic? You guys know the story. It's nothing new on Wall Street. There's a quote from Jesse Livermore, by the way. There's nothing new under the sun. That won't change as long as human emotions are involved in investing. That's just how it works. Okay. On macro, growth and profit optimism surged. Really nothing there. I don't pay attention to any of this. Not a big deal to me. It is a midterm election year. Let's talk about this. Okay. On politics and risk, investors see U.S. midterms Trump wave 16% as likely blue wave on this here. Look, it is a midterm election year. I talked to all of you about this in our 2026 outlook, and I gave you guys some stats and some data on this. And I'm not saying it's going to happen. I want to be clear with this. For those of you that are watching this, that have come across this call, what we don't do is, I'm not an investment manager that tries to predict where the S&P is going. If that hasn't been evident already on this call, I'm going to say it again. However, I was a futures trader early on in my career, so I do pay attention to price action and a lot of other things for the markets. Looking at the S&P from a technical perspective, I don't like where it's at currently. And I gave you guys some stats, like I said. I'm going to go through them here quickly for a midterm election year. Since 1934, there's been an average during a midterm election year of a 22% pullback. Since 1950, the S&P gain is 5% with an average 17% drawdown. So no matter where you pull it from, let's call it 1950. Maybe it's not fair for 1934, given a lot of factors. But 1950, I think, might be a little more reasonable. The point is, you should expect a market pullback. Okay? I can give you the obvious reasons. Iran's a big situation. I don't know what's going to go on there. You guys know he's in the White House. This isn't a political show. A lot of things can happen pretty quickly in the market. So I don't like the highs here personally. Again, we'll take steps to mitigate the portfolios. One of the steps we've taken, which I talked about with a lot of you guys, is where we allocate capital to in 2026. Healthcare, defensives, and consumer staples perform in cycles like this. So you are seeing a lot of other portfolio positions we're not talking about in this show for privacy concerns in portfolios that are based around that. And if you go and look, I talked to some of you about this recently. We've got a little bit of volatility here in January. On the days that we sold off, those consumer staple names weren't down. They were flat or up 1 or 2%. That's fine. That's what we want to see. What names were down, okay, and we'll talk about gold here in a second, were the tech names, were the Mag 7 names. And I'm telling you all here and now, you should continue to expect that to happen, because what you're going to get to here in a second, that trade is crowded, okay? Those trades are massive. Some of the other portfolio positions we're talking about, I'm not going to get into the show on. Nobody on CNBC is talking about them, okay? Your financial advisor that works at Mutual, Omaha, or Wells Fargo, or the person that's cold calling you, they're not talking about those names, okay? This is where we traffic in. We look for value. We look at things nobody pays attention to for a reason, okay? So the portfolios are put together very specifically. They're well thought out. And again, we've thought out 2026 and what our views could be. All right. Let's get into some of the charts here from the FMS. This is the BofA Global FMS Investor Sentiment. Highest since July 2021. Okay. I'm not calling top. All I'm saying is caution, caution, caution. We're positioning where we want to be positioned, and we'll continue to watch this. FMS cash levels dropped to a record low of 3.2%. And by the way, when I was recording the first show on this, I got to this section and I go, we're at 3.6. And I go, you know what? I think I'm reading the old fund manager survey from November. And I got to, and I was like, you know what? I'm reading it and the wrong one. And I go, look, I'm going to re-record it, which I'm re-recording now. Okay. You don't want to see this. If you go back to April, everybody was chasing the rally, which they did. And by the way, I'll say this, not a quick victory lap, but a small one. I don't like doing them too much. We were able to generate returns from April into the fall rally without buying a single tech name in portfolios. Every position we had in portfolios was not tech related at all. And we did a good job last year, I think. Okay. And you guys know because you've seen your portfolios. All right. So that's that there. Let's get into the next thing here. The midterm election year I talked about already. Expect volatility. I don't want to keep beating a dead horse. We expect that to happen. I'm not really concerned about recession. Let's skip that there. Let's go into here. Let's go here. I put some notes here. This is me on my phone, by the way. I was out on a walk and I was reading and on my phone taking quick little notes to talk about things. Okay. This is chart 11 from the FMS. Investors see geopolitical conflict as the biggest tail risk going forward. Okay, in November it was AI bubble. This has obviously changed since Venezuela, since we're sending ships to Iran, etc., etc. I don't disagree with this. All right, this does concern me for a lot of reasons. And again, what I'm going to say is this. We'll move to chart number 12. If things start to get bearish, the first thing that's going to get hit is Mag 7. Okay. For a while, I knew this in the last recording I was doing. This was there. I go, this is probably shifted, by the way. And it did shift. Okay. The most crowded trade is long gold. Okay. The second most crowded trade is long Mag 7. Okay. If you guys didn't see what happened today on Friday into silver, into gold, well, there you go. Okay. This is absolutely one of the craziest things I've ever seen in markets. I'm pretty sure I knew it was coming. Again, we don't short stuff like this, but stuff like this just never lasts, okay? And when there's no liquidity in the market, which there wasn't, okay? When everybody's rushing for the exit, think about it from this perspective. And this is a bad perspective, but this is the way that somebody gave it to me a long time ago. If you're in a gym and there's a fire in the basketball gym and you've got to rush out or arena, the exits are going to get filled really quickly. It's hard to get out, okay? Every single time when you get situations like this or in silver, when you want to exit, guess what? The liquidity on the order book disappears, okay? This is exactly what happened today. Obviously, there was news that came out with the potential new chairman for the Fed, etc. But it's concerning, okay? And it wasn't just these two ETFs. Metals, miners pulled back. And by the way, to be clear, I don't care about this stuff. We cared about this stuff 2 years ago. We bought wheat and precious metals. There's a question that came in. I'll talk about it later on that, okay? But I want you guys to think about it from this perspective. If things end up happening in the marketplace and things get bearish quickly, what do you think gets hit first? Okay, it is the Mag 7 stuff. And by the way, for those of you guys who haven't read this, if you go over to the website, go to here, click on papers. We need to update this, by the way, because there's some other stuff we put out as well. I need to update that, okay? The biggest hurdle facing market should investors, I'm sorry, not this one. This is note to investors. It works until it doesn't. If you read this paper, I talk about Mag 7 and the concentration of them. This is what I've been talking about for nearly a decade over and over and over, okay? And I'm not worried about any positions we own in portfolios at all, by the way. We own healthcare, defensives, consumer staples, and turnaround positions, some value stuff. If the market pulls back, those names aren't going to pull back with a large market. They might be down 2 or 3%, 5%, but I promise you they won't be down 20% like a lot of these other names are going to be down. All right. So that's a big deal to pay attention to there. Let me keep going because we're short on time. We're at 50 minutes. I don't want to keep you guys for too much longer. All right. Chart 16, expectation for large cap stocks outperform small cap is the lowest since 2025. What have I said to you guys the past year or so? This is happening now in 2026. Small cap is going to outperform large cap. So if you look at your portfolio, you look at positions we've talked about, the reason we have small and mid cap there is because we want outperformance. We're not just going to sit there and dive into equities because we like them. We're going to drill into the idea, drill in deeper, find a smaller mid cap, build a portfolio out of small positions in those names, and ride those waves into returns. All right. So that's that there. Let's move on to some more. This is chart 20. This is the biggest tail risk. Now it's at geopolitical conflict. It was the AI equity bubble. And by the way, don't rule this out, by the way. Okay. Who knows what's lying under the surface? And I'm not trying to facilitate fear here. What I am saying to you is who knows what's lying under the surface, a lot of this tech stuff. Okay. You guys know the game that NVIDIA and everybody's playing. All I'm saying is from a risk perspective, why play that game? Okay. And again, I'm going to take this back one perspective and be biased here. This is why we do what we do. This is why we go after value. This is why we go after names nobody's paying attention to. When the masses are all paying attention to one thing, you want to go and look at other things. And when they want them, you want to be selling it to them, i.e. Boeing, VF Corporation, other names. Astronics, by the way, we talked about that. If you guys don't remember, it was in your portfolios. That's what we want to pay attention to, okay? This is the chart going back from other stuff. This was, obviously, coronavirus was a big deal. This is where we are now, okay? I think this is is reasonable. And from a tail risk perspective, and by tail risk, for those of you guys that don't know what that means, it means there might be a situation where, and I'm giving you a parse definition, an unforeseen situation that causes, long day. That causes an unforeseen situation in the markets. Okay, let's move on here to talk to the next one quickly. We'll go through this, and I think that's it. No, we have two more. I know I marked two more here, and we'll complete it at 7:30. So you guys got to bear with me. I've had an incredibly long day, and I'm trying to get this out for the weekend and get started with a few things here. Okay, FMS asset allocation. Net percent asset allocators say they are overweight equities. Again, this will shift. Everybody rushed into this. That'll shift relatively quickly. Overweight bonds, we'll skip this here. Overweight cash, we talked about this there. Let's go through two more. I know I marked here on this here. And that'll be it. We'll go to the questions. No, let's move through this. Japanese equity. I'll talk to you guys about Japanese equities. I know I talked to you guys about a letter on this. We'll probably start moving into this in the second quarter. I hadn't forgot about this just right now. There's too many ideas on the U.S. side, but we are fans of Japan, to be clear, and we're going to put some money to work there eventually. Probably the second quarter, I think. We'll start to get money to work there. Okay, this is overweight technology. Again, just repeating the same thing I've mentioned over. Here's what I want to get to. This is a final point. All right, so global consumer staples, net percent of FMS investors, overweight consumer staples. They are now underweight. Okay, this was back in 2020, 2021. Investors are 30% underweight consumer staples. All right, this is a big deal. This will move back to mean, reversion to the mean on this. And we own a lot of consumer staples. They're not sexy names. Some of you guys know what they are. Some of you don't. You may have never heard of them, but this is what we want to own in a cycle like this. They will outperform when the markets start to get turbulent, which is going to happen. Okay, it's not a matter of if, it's a matter of when this year, and we're positioned accordingly for that. All right, I think that's it. One more. Okay, the final is energy. FMS allocation energy is 29% underweight as well. We are allocated into this already. If you guys have looked at your portfolios, we have offshore drilling companies in the portfolios. We added some of those positions this week. Guess what? They're also small cap businesses for a reason. So we put together a little mini basket of offshore drilling companies that we expect on a few of them to get pretty close to a double, if not more. Again, this is opinion, not advice. This is not a solicitation at all. I'm talking in generalities, okay? So we have our price targets on this. I'm not talking about the names publicly on the call. If you guys look at portfolios, all that stuff is there. But our valuation targets are much higher, and we do think this has been underweight. This will shift to, and it has been already, to be clear, into overweight in the coming months, all right? That's it for the FMS survey. We're at 52 minutes. We've got through a lot this week. If you're still listening, congratulations. I know it is a lot when we go through on these shows, but I try to pack in a lot very, very quickly so you guys can listen to this stuff or watch it, however you guys do it. I'll tell you this. When I listen to some podcasts, which is not a lot, I do it while I'm walking the dog or on a quick hike, or if I'm driving, I try to get them in. By the way, if you guys don't listen to earnings calls, I know they're not great. Simple hack, probably not groundbreaking. Just set the speed to 1.5 times so you can get through them quicker. It's literally what I do. This week I had to listen to 4 earnings calls. I had them at 1.5 speed, and I got through them quicker. Okay, so that's it. That's it for this week's show and the market call. For those of you guys who are returning, welcome. Or new here, welcome. For those of you returning, appreciate you guys tuning in on this. Please make sure to send it to a friend if you find value in this. It'll help us to continue to build the community and to get the market call out to all of you guys out there. Again, this is opinion, not advice at all. Consult your own financial advisor, your guru, whoever that may be. All right. Now for the Q&A section. I have a few questions that came in this week that I want to go through quickly. One of them was from Christian. Christian asked effectively, let me pull this up here. Hey, Nick, can you talk a little bit about your process on going to find a lot of these stocks you talk about? Last year, you were pretty spot on a few of these names. So I'm curious to how you go about screening into these names, especially a lot of these turnarounds. All right, so the first thing I do typically when I'm looking at equity ideas is I try to understand the cycle that we're in. So obviously right now, we're in a cycle where you're getting rate cuts. So if we can help it, small and mid caps will outperform, consumer staples will outperform. So I start to look from that lens. The second thing I'll do, if we're not in a cycle, is I look at companies that are at 52-week lows. And that takes time. You got to go through, look at them. Whether it's fresh 52 doesn't make a difference. What I'm looking for is companies that have been sold off. And then I start to go and understand what those companies are doing. I go through them. And from there, I can start to build a list. I'll give you a quick example. 2 weeks ago, we were looking at trucking companies, and I was trying to understand why trucking could recover. I've come to the conclusion that we don't think we're going to see a big recovery, but once we understood that, we just start going to the financials and figure out what's going on. Okay. The final example I'm going to give you is this. I'm going to use a clear example to this. If you guys remember, if you guys were here in 2024, and this will relate to the gold question because the gold question just came in that I didn't answer, but I hope you shorted it because you were dead on, by the way. You know who you were who asked it. So, in the summer of 2024, our view was that inflation was going to take off. And our view was obviously correct because this is where the stock is now. It's basically a triple. And the way we wanted to play that was not through the mining companies. We wanted to play it through a streamer. Wheaton Precious Metals is a streaming business. What that means is they don't own the mines. They buy the rights to the metals that come out. Now, once we take that idea, we look at the balance sheet. This particular company had no debt, by the way. Let me be clear with this. Literally zero debt. They had a 50-person team. They were doing large share buybacks, and it was widely unknown. Okay, I'll tell you another quick story to this. I know it's a long-winded answer to your question. Not a single person would pay attention to what the CEO, this is a debt, by the way. This is their profit margins. This is free cash for the last year. This is revenues, by the way, all inflecting. This is cash, etc. I posted a YouTube interview. The CEO was interviewed by a small podcast. When I posted the interview, it had 500 views. That podcaster asked him exactly what they did, how they did it, and what they expected the business to do. He literally gave all of the answers in a 15-minute podcast. When I posted it on Twitter and online, maybe a month later, it was still less than 1,000 views. Okay? This is what I'm talking about by paying attention to things nobody talks about. You don't have to sit there and come up with these esoteric macro investment ideas or try to worry about GDP or all this stuff. You just have to worry about finding good businesses. If you take that perspective and think about buying a business, this business tends to get a lot easier than people make it out to be. Okay. And that's that. Okay. I know it's a long answer, but that's that. And I'll tie it into the next question. There's a question that came in. I won't say the name on this. You asked me about shorting silver and gold. If I would be using the inverse ETFs or directly shorting on the ETFs, I didn't reply to you because I was busy. I hope you shorted it. The answer to that is really neither. It's just not what I do or what we do in portfolios. I don't make bets on this stuff here. Obviously, this would have been a big win, but it's not what we do. It's hard to determine, for me anyway. There might be others that can do it, when this is going to sell off. I don't know. I don't even know if it's a buy. I don't have opinions on this stuff. And to be clear, I'm not obligated to. You know, I try to stay in our lane and what we do, and we do it well. I leave this stuff to the professionals in their business. Okay, so hopefully you shorted it and made money. If I would have done it, I guess hypothetically, probably on the inverse ETF, I would have just bought the shares personally, or maybe looked at miners to short. I don't know, but again, hopefully you made money on that. All right. So I think that's it. And there was any other questions? There was one more question on it on tech, but I answered it already for you guys. I think that's it. Okay. Yeah, that's it for this week's market call. We're under an hour. Great. We got done with this pretty quickly, and hopefully the new format's a little bit better. I know they're short. I know they're long. For those of you guys that listen, great. It gives you guys a chance to get insight to how we invest. For those of you guys that are new, keep listening to the show. Watch it if you can. You'll get more value out of it. You can ask questions. If you have questions, go to the website. Ask those questions. Please go to the LongVol Research website. Don't go to the investment site unless you're a client. Then go to that site. But go here, go to the contact tab, send your questions in there for that. This is the podcast link. You can go here and click this. If you're a potential client in either one, you can click this stuff here. It'll take you to all that. Okay. That's going to do it for this week's market call. Thank you guys for tuning in. I'll see you guys in 2 weeks again for the next market call update for all of you. And enjoy your guys this weekend. And thanks for watching.